Welcome to the high octane world of crude oil futures options trading. Yes, this is a volatile market and it can make or break portfolios. However, if you do it right and you protect yourself from the risk that's involved with trading futures, you can make a lot of money. In the next few minutes, I'm going to break down the crude oil futures options trading strategy that can make a difference in your portfolio. Whether you're a seasoned trader or a beginner, if you're interested in the oil markets, stay tuned. Before we get started, if you appreciate the time and effort that goes into making these videos, be sure and hit that like and subscribe button down below. Also, download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. Welcome to our deep dive into crude oil futures. Let's start with the basics. Crude oil futures are standardized contracts traded on exchanges like the New York Mercantile Exchange or NYMEX. These contracts represent an agreement to buy or sell a specific amount of crude oil at a predetermined price on a future date. Now let's talk about West Texas Intermediate or WTI crude oil. This is the benchmark for U.S. oil prices and one of the most actively traded oil futures contracts in the world. WTI crude oil futures are incredibly liquid with over 1 million contracts traded daily. This high volume makes it easier for traders to enter and exit positions very quickly. Each standard WTI crude oil futures contract represents 1,000 barrels of oil, while micro contracts represent just 100 barrels. This flexibility allows both large institutions and individual traders to participate in the markets. The crude oil market is known for its volatility. So with that, you can make a lot of money or lose money. It's influenced by certain factors like geopolitical events and global supply and demand. Let's dive into the current state of the crude oil market and the fundamental factors that are driving it. Recent price movements have been volatile. Brent crude was up over $90 per barrel in September of last year, and it's since retreated to below $70 as of early this November. This decline reflects a complex interplay of supply and demand factors. On the demand side, we're seeing a significant slowdown in growth. Global oil demand is expected to increase by only 900,000 barrels per day in 2024, which is less than half of last year's growth. This deceleration is largely due to China's economic challenges, with Chinese oil consumption actually contracting in recent months. Supply, meanwhile, is set to reach record highs. Non-OPEC producers, particularly the U.S., are driving the increase. OPEC, on the other hand, has extended production cuts until the end of 2025, attempting to balance the market. Geopolitical tensions continue to influence prices. The ongoing conflict in the Middle East, particularly events involving Iran, adds a risk premium to oil prices. However, the market has shown resilience to these disruptions so far. Looking ahead, the global economic outlook remains a key factor. Persistent inflation, financial stress, and China's economic slowdown all pose risk to oil demand. OPEC's decisions will be crucial in the coming months. So in summary, we're in a period of slowing demand, increased supply, and geopolitical risk. But with volatility and uncertainty comes opportunity. Now, as you can see from this chart, there's pretty good support at around $66, and this is over the last 2 years. When we get down to this range, I like to throw on some put credit spreads in order to collect premium, as I think the risk to the downside, despite all the geopolitical and the supply and demand factors, I still think the risk of going down is much lower than the risk of it moving up. So I like to go long oil when we get down to this range. And that's what I'm going to show you how to do in the live trade. Okay guys, we're on the Tastytrade option trading platform. We punch in /CL right here in the upper left, and we will see the different option chains that pop up. These are the regular option chains. They also trade, we can put all expirations, and you can see every other day these crude oil futures are traded. But I like to use the regular chains because they're more liquid, more volume, and easier to get in and out of. So I'm going to go to the December chain and open up that, click on it. We're 30 days to expiration. And that's the first option chain. We open it up. Calls are on the left, puts are on the right. We're going to sell a put credit spread. So we're going to go down here to the 36 delta. So that will give us a basically 1 minus 36. That is a 64% probability of profit. So much better than 50-50 of making money. And we're going to click on the sell to sell the 65 strike. And then we are, for protection, going to buy the 64 so that we can't lose more than the width of the strike, which is $10, minus the 33. So because of the way that the option contracts are structured, this 33 is really $330 that we're going to collect upon placing this trade. And our max loss is basically the 1,000 minus 330, which is $670 is our max loss if it went down below the 64. But if we click now, we're on table mode. If we click on curve mode and then analysis, you can see our profit zone. We're currently at almost 67, 66.88 right here. We can go all the way down. It can move down further, and we still are profitable. We collect that full $330 over the next 30 days if it ends up the price above 65. And then we can go all the way down here to 64.67 and still break even. But when we get to the last few days, if we do move down this far, I'll just close it and roll out to the next month and wait for that. So there's kind of a backup plan as well. And you can see with the chart, like we went over, this is the 1 year chart, and you can see we're at the bottom of the Bollinger Band, bottom of the RSI, below the 200-day moving average. There's great support here at 66. And my thinking is, despite the global and political and supply and demand, all those factors, just based on the price chart, I don't expect it to go too much further down, if any. And for any number of reasons, any other news that comes out, it can move up quite a bit. So this is kind of at lows over the last year, you can see. So that's why I'm trading this spread. From here, we hit review and send, and we place the trade and collect our $330. And of course, if we want to increase the quantity of contracts, instead of $330, we could double it and collect 660 if we do 2 contracts. So you see how it works. All right, guys, to wrap up, crude oil futures always carries significant risk with the volatility. So I like to use stops or trade spreads so that I can't get hurt on any big move in the market. And I like to capitalize by collecting that premium. If you appreciate what we went through in this video, don't forget to hit the like and subscribe buttons down below. Download the free options workshop. Join Moo, join Tasty Trade using the links. Leave a comment. Let me know what you're trading. Are you trading crude oil futures or something else? Let me know your hot trade. Thanks for watching. I'll see you in the next video.